Today I'm going to talk to you about capital gains and basically tax implications. Capital gains are anything that, say you bought something for one price and then you sold it for more than what you bought it for. So let's say that's a house, a car, stocks, anything like that. If you hold it for more than 1 year, they're considered long-term capital gains. Anytime you sell something and you've held it for less than 1 year, it's called a short-term capital gain. So the benefit with long-term capital gains has some benefits in taxes. So long-term capital gains, if you're single or married jointly, or a qualified widow or widower, there's other ones, but these are the most common ones. So you have 0% tax if you have less than $47,025, or 0% tax as long as you make less than $94,050 in a year. So effectively, anybody making less than that amount of money in total for the year pays a 0% tax on their capital gains. If you're married filing jointly, again, $94,050. As long as you make less than that, you pay zero capital gains tax. So that's a real benefit. It doesn't even have to be in a retirement account. And in fact, I'd probably sell my stock if I knew I was making less than that. Say I got laid off for 1 year, I could sell the stock and then buy back a different stock, and then I don't have a wash sale, and effectively I'll have 0% tax, and that will give me a new tax basis for the subsequent year, but I can go through that some other time. You only pay 15% tax at these rates and 20% tax if you make above that amount of money. There are some special rules that give you additional tax benefits. So like I had a house, I lived there for 4 years, and I sold the house. And I, at the time, was married, so as long as I made less than $500,000 of profit from the sale of that house, I pay 0% tax on that money. Now, let's say if every 2.5 years I buy a fixer-upper, I live in the house while I'm fixing it up, I fix it up, and then I sell it, and I sell it for a profit of, I don't know, let's say, $490,000. Well, effectively, because I'm married, filing jointly, I can actually pay 0% tax on that almost $500,000 worth of gains. If you do have long and short-term capital gains, there's something called a net investment income tax of 3.8% above $200,000 for a single filer, or $250,000 for married filing jointly, and that's from modified adjusted gross income. So just be aware of that. That might hit you. Let's say I sold that stock less than a year of holding it, or whatever it might be, and I'm taxed at the short-term rates. And that means it's just ordinary income tax rates. So that could be anywhere from 10% all the way up to 37%. If you've ever heard Warren Buffett say that he actually pays less in taxes than his secretary, this is why. Let's say you have a single filer and the money made above $100,000 a year, they're being taxed at 24%. So if this money was made not going to work, but instead being from a capital gains, your capital gains, you would be taxed at 15%. And Warren Buffett, he makes more than $500,000 a year, so his tax rate is effectively 20%. And even in some states, say like Florida, Texas, Alaska, they don't have capital gains tax at the state level, so you're just paying the 20%. On top of this, because they're working for the money, effectively you'll pay your 24% federal, you'll pay your percentage to Social Security, Medicaid, Medicare, you'll still have to pay your state tax, your local tax, and your unemployment insurance and things like that. So that's why Warren Buffett basically will make comments where he actually pays a lower tax rate than, say, an assistant that he has. The reason why this 37% doesn't really matter that much, this could be 90%, is that most wealthy people don't go to work for the money. What they do is they make money as they're young, they invest that into assets, and then they may be selling off assets, which are then capital gains. It's not ordinary income, and as long as they hold it for more than 1 year, they're only going to be paying 20% tax. And if you have a business and the business is generating a lot of money, why would you continue to pay it as ordinary income? You would incorporate that business, and then you would pay a much lower tax for a corporate tax rate. So if you'd like to learn more of how to make money, how to keep more of your money, and how to invest, subscribe. This is a channel for you. Thank you for watching, and have a great day.